Good afternoon, everybody. This is Patrick Donahue, fellow member of Entrepreneurs Organization Minnesota. Thank you, everyone, for being on the line today. A huge thank you to all of the strategic alliance partners that help make EO Minnesota a awesome experience that is unrivaled to anything else that we have as business owners. We've been very grateful to all of our sponsors who have stepped up to really help through this time of chaos. We've had Fidelity Bank and Eide Bailly and Great Plant Moody and Insperity all give presentations. RBC was willing to give a presentation right away, but of course the markets have been absolutely chaotic. So we're very grateful to our friends, Bill Bard and Mike Dixon, that are with us today from RBC Wealth Management to share insights on this market. Specifically, want to give shout outs to Chris Carlisle from Great Plant Moody, Brad Tyson and Tammy Hutter from Eide Bailly, Jeff Campbell, Courtney Taylor, Joe Morris from Fidelity, Courtney Howard, Sally Pine, David Bruni from Insperity, Patterson Tinty. Thank you to Tom Dixon, who might actually be related to Mike Dixon. So
he won't admit it.
Yeah, well, we're going to probably hear some jokes today, too, from Mike, I'm hearing. So, Tracy, Dan, and Jim Reike from Patterson Tinty. Of course, we have Bill and Mike on from RBC today, so we'll get to them in a minute or two. Chris Peterson from CLP Digital Marketing, and Matt Beecher with Vision to Traction, who's been especially helpful for our accelerator program. We have a number of awesome events coming up, and I'm just going to give a plug to EO Global, who has done an unbelievable job hosting global webinars to people that are usually very expensive and difficult to get in front of. I've been on a number of them. They just posted a bunch of new ones that I signed up for the other day. So some of these are coming up as well. So make sure you're checking out the EO Global events. Specifically, we're going to call out some events coming up. Later today at 3 o'clock Central Time, we have the EO Online Summit titled Unshakable Marketing and Sales Strategies for Uncertain Times. It is going to be 8 of the world's top sales and marketing experts doing 15-minute sessions. I know I'm going to be hitting that one up today. April 30th, which is tomorrow, Thursday at 11 a.m. Some of you may remember the EO New Jersey member, David Steele, as he spoke to EO Minnesota last year. He's very well received. And so this is a chance to reconnect with David and see this again. He is presenting on, quote, what you need to know about social media and absolutely must to succeed. I know I've invited a key employee to join me on this call as well, because I do want to hear more on this. May 5th at 4 p.m., we're going to be talking with Alan Miltz. I was on a global call with him a few weeks ago, and he did a superb job. He was supposed to have presented to our chapter on March 16th, what I like to call St. Patrick's Day Eve, but of course was not able to do that. And the good news is we have him coming in the fall, but even better, on May 5th, you can jump online and learn about optimizing your cash flow during the COVID-19 crisis. He has gone all out to help out EO. He's provided free access to online tools, so highly recommend jumping on that. On May 7th at 11 a.m., we have Fidelity Bank coming back. Very grateful for all they're doing. A lot of people have questions on the PPP and SBA programs. We're doing part 2, talking about working with your banker in the times of economic uncertainty. They'll be sharing updated insights, what they've seen through the PPP process and other SBA loan and government money opportunities. On May 14th, we have Insperity presenting Pandemics Box. Now that we're working remote, where do we go from here? I will have to tell you, I've heard from a number of EO Minnesota members that they have been very grateful to Insperity that they made the PPP process as easy as it could be, providing numbers on their HR stats and all that as part of that application process. So Insperity has been getting a lot of love from EO Minnesota members over the last several weeks. They've really come to bat in the time of chaos. And then finally, the last event I want to bring up, May 14th at 7 p.m., we are going to talk about the EO and Freak Factor for couples, discovering uniqueness by flaunting weakness with David Rendell. And so this is open to all EO members, spouses, life partners. So, and also Dave gets high ratings from EO Global all over the world. So please check that out on May 14th and join us. So with that, very grateful for everybody joining us today. You see on our screen the sponsors. Very grateful for RBC Wealth Management being available today. So of course, we have our friends on, Mike Dixon and Bill Bard. Many of you have met them at events and throughout the last couple of years. But then they are joined today by Jason Stevens, who's with Alliance Bernstein. My whole background is in finance, and so Alliance Bernstein is very well known. They provide institutional money management. So people like RBC and financial advisors like Mike and Bill will partner up and utilize firms like Alliance Bernstein as part of their asset management programs. And so Jason is based here locally in Minneapolis, so it's wonderful to have him here. I was able to catch up with him beforehand. After he graduated from Minnesota State, he was very lucky. He got a really nice job at Janus in Denver. That's meaningful to me because that was a very well-known firm in Denver, and then he was brought back to Minneapolis to work for Columbia, now Columbia Threadneedle, and now for Alliance Bernstein. So we have some heavy hitters on the line here today to share all the insights on what's happening with the market. It couldn't be better timing. This is my third economic crisis, and I've been trading a bit in the stock market, but it's been mind-bending watching the stock market, again, nearly hit new highs today when we've got an economy that's nearly shut down. So I know I'm super anxious to hear from the experts, Bill, Mike, and Jason. So with that, gentlemen, thank you. Thank you for being here today and sharing your insights, and I will hand it over to you.
I'm going to kick it off for us. When I talked to Glenda, we kind of discussed an agenda for today, and the first piece would be just a brief background on RBC and Lambert Dixon Group, simply because we are relatively new EO sponsors, and just to get a little more commercial about where we're coming from. And then I'm going to hand it to Mike Dixon to give a little kind of our observations on the economy and the markets, and then hand it to Jason to give his observations on the markets and the economy, and then open it up to Q&A, because I think that's probably where a lot of value can be here. But we'll probably spend 20 minutes or so on kind of our general observations. Just briefly then, RBC, just so you know, RBC and Toronto Dominion are the two strongest banks in the world, very substantial global banks, so very safe and secure. So it's a very good place for Mike and I to work because we feel secure. And it's a very good place for our clients because I think they feel secure in terms of being a custodian. The RBC Capital Markets is a global investment research group that Mike and I draw that's our kind of a core source of information and knowledge about the markets and what's going on and strategies. But then we're fortunate that we partner with a number of firms, but in particular, there's probably 3 or 4 firms that we do a lot of work with in terms of research and discussion. And one of those is Alliance Bernstein and Jason Stevens. And Jason, as Patrick gave you a great background on Jason, and Jason and I have known each other for 12, 15 years throughout my career. I've kind of worked with him in a number of different places, and he's terrific. And Mike and I had a call with him on Monday, and we just thought there was such a good discussion that I thought, you know what, Jason, we'd love to have you on this call as well. I think he could add some additional color to our story. So that's kind of the connection there. If you'll click to the next slide. There you go. So just briefly on Lambert Dixon Group. So this is Mike and I are part of a group called the Lambert Dixon Group, and I'm fortunate to have joined Lambert Dixon just about 4 years ago now. I had spent most of my career at most of my career at Wells Fargo. Mike, Dixon, and Carl Lambert have been partners for over 30 years. And they've really built quite a business. They focus both on institutional money management and on private wealth. And I think what I was impressed with, I've known Mike for almost 30 years as well. What I was most impressed when I joined the team was their discipline around the investment process. And I think they honed that discipline through their institutional practice that they had. So our approach, kind of our story for clients is that we put the financial pieces together for you so you can focus on things that are most important to you. The idea you're running businesses. We want to be your chief financial officer, chief investment officer, and help manage financial affairs under your direction while you run your business. And we are very collaborative, both internally and externally. We have a kind of planning orientation. We will kind of look out, where are we going? Where do you want to go? And how do we want to get there? And we try to be very disciplined in our process in helping you achieve your goals. And again, we have a kind of global platform of resources. Next slide. And the team, the Lambert-Dixon team, is Carl Lambert, Mike Dixon, and Bill Bart are the three primary advisors, and our associates, Wendy Scarns, her, Molly Halsey, and Grant Farley. And this is I haven't been in this business a long time. I work with a variety of very good teams. I've had fortunate working with good teams of people at Wells, but here at RBC, I guess it's bragging or it's self-serving, but this is the best team I've ever worked with in terms of collaboration, expertise. Mike, Carl, and I view the world, modestly differently. So we're in sync, but we're different enough that we challenge each other. I think Mike's got a line, if everyone's in agreement, then one of us is unnecessary. So we have enough difference of approach, difference of view. Carl is a CFA, and they're kind of a chief investment guy. Mike has really focused the development of the institutional business, and I've really focused on kind of the wealth planning side. I'm kind of with a lawyer and a trust background. Wendy Scarns is our key person on the institutional investment side, really developed a lot of our reporting capability. Her, Molly, and Grant focus most of their time on the private wealth side and are very disciplined and great client service and execution. So that's kind of the quick background there. Let me hand it over now to Mr. Dixon to kind of give his thoughts and our kind of point of view on the markets. Mike?
Great. Thank you, Bill. I appreciate it. Thanks, Patrick, for the introduction, and thanks for the opportunity to be here. For the record, I don't agree with Bill on anything, so I just want to set that straight right from the beginning.
I'm trying to be nice.
Yeah, I appreciate it. And Tom Dixon is my brother, and he's older, although he has more hair than me. So we'll talk about that later. I would just start with just a quick backdrop on what we see out there. I think Patrick did a great introduction and talked about a lot of things that are happening. And let me sum some of that up and kind of how we look at it, and then we'll turn it over to Jason. He's truly the best at kind of digging deep. To Patrick's comments regarding the market, right now the markets are really on a tear, and it's amazing to us that happens. There's kind of three stools that are happening right now, or three legs to the stool. We got the pandemic, we've got the economy, we got the market. Whenever there's good news on the pandemic, things happening or progression or flattening out the curve or whatever it may be, or the economy, the market just is on a tear. And so we are really trying to determine whether we have a V effect going, where we have a sharp down and we come out of it quickly, or it's longer like a U or a W, and there's some other things that we'll look at. But I thought it might be useful to start with just kind of a backdrop right now. So for the first quarter, the U.S. economy contracted at 4.8%. We're expecting about 4% with a Reuters consensus, and it came in beyond that, which is no surprise. This is the sharpest decline we've had since the Great Depression, and so it's really hard to factor in that kind of a slowdown or a halt, if you will. And as business owners, I know this group is is very aware of what's going out there. This effectively ended the longest expansion we've had in U.S. history. This market was really growing, and with all the actions that the Fed did with the twist and quantitative easing, we've really had this market excel for quite some time, and that was exciting. It was a good time for us. This plunge was exacerbated in the last 2 weeks of March. It really slowed down. Jobless claims, I think at the end of March, were somewhere around 22 million. Now it's 27 million. I mean, we are effectively just coming to a grinding halt, and we're looking for data and news to get out of that. A little bit about COVID. You know, we have 1 million documented cases in the U.S. We think that number is probably quite a bit higher, but that's what we go with. We've seen many industries really hit by this, and it won't come as a surprise. You know, energy has been decimated, and we had a day where we had negative oil prices just because of supply. Travel, leisure, healthcare has been really wounded from the elective side of things. I mean, it's crazy what's going on out there. Airlines, I read, I think yesterday, that 65% of commercial planes are in storage right now. I mean, these are industries, and especially when you come into travel, air travel, that's crucial. I mean, the government's going to have a bigger hand in that, and we think that that'll happen. So through all this, uncertainty and volatility are at a premium, and it's just crazy out there. There's absolutely a enormous amount of pressure to restart this economy. Congress approved the stimulus package. It's about $3 trillion. Fed cut rates to almost zero, and has essentially become the backstop bank for the United States. The PPP, the Payroll Protection Program, was $349 billion. It was out of money in 2.5 weeks. On April 16th, they ran out of money. Just under 1.7 million in loans, around 200,000 alone. So on April 24th, another 310 billion was kicked off into that program. And we see, you know, there's some, we're encouraged that it's there. There's some flaws with that program that you see and you read about on a daily basis. But when you boil all these things together, what's happened with the economy, what's happened with the virus, the consensus among economists is that it's not enough, that more stimulus is going to be needed to get us out of this. And we can certainly see why that may be the case. I'm going to turn it to Jason in just a moment and look a little bit deeper. But if we can go just to slide 4 on our stuff, I just want to point out 2 things right there. So this is, we just use this as a perspective slide. This looks at all the post-war bear markets from when they started, the trough, the recovery, the number of days to get back. And what you'll see here on that February 19th, the market hit a high of 33.86. On March 23rd, about a month later, it closed at 22.37. It was down 33.9%. That's a big, fast drop, 23 days. What we know, and what Patrick had alluded to, is that the S&P today is off 8% intraday. And I'm not on that screen, but I think it was 8.3 or something like that. So this market is really trying to figure out what to do. This market is pricing in, if you just imagine there's no corona for a minute and looked at the valuations, we'd be fully valued and then some. So this is a little bit mind-boggling, and we're pretty cautious, and we'll get to more of that in a minute. Let's just look at the next slide, and then this will be the last one I go through. This is looking at, this goes back about 100 years, and it's looking at the largest daily advances and declines. And so in the last of the top 10 up and down, we have 3 in the last 20 trading days, which is crazy. If you go out to 20 days, that number jumps up dramatically. And this isn't point drops, this is percent. So this is meaningful stuff. So Patrick, I hope you're trading successfully because you're getting a lot up and down, but this is really hard stuff to navigate. The building block of everything we do is valuation. And without knowing where earnings are coming in, this market is so frantic, moving up and down. And so I thought this was just kind of another way to look at volatility and share some of those thoughts. I'm going to turn it over to Jason now. We can look at some more of this and then talk at the end if there's questions about how we look at this.
Hey, thanks, Mike. Can you guys hear me okay? Okay.
Yeah. We can
Okay, fantastic. So I think we're waiting for a few slides to pop up here, but I'm gonna look. I want to spend maybe 5 to 10 minutes building on what Mike talked about. Try not to show slides that are redundant, but show maybe a few different points of view on things that my firm, AllianceBernstein's, thinking about, and then would love to open this up to some Q&A. And I believe Patrick's going to be kind of keeping an eye on that Q&A feature here. And if you have any questions, pop them up there, and Patrick, jump in at any point in time. So I think we're still waiting to.
You want your presentation up, right?
Yeah, there we go.
Perfect.
So for those of you on the call, you can see that this is a 52 slide presentation. I'm going to only go through the most impactful 51 slides. So
well, we blocked all 3 hours, so we're good to go.
Fantastic. So this is a presentation that my firm, AllianceBernstein, publishes every quarter. And I will tell you, this quarter has been probably the most interesting quarter of information. And maybe as a way to begin, why don't we start by just going to slide 6, and I'll let that sit up there, as maybe I just share with you a couple of data points that have jumped out to me. Mike mentioned there's 3 different columns of kind of what the world is looking at. It's the pandemic, it's the economy, and the market. We couldn't agree more. I mean, let's start by just looking at the economy. I'm looking at some notes from my economist, and he's sending us information every day, and it seems as if the ball is moving all the time. But let's just talk about GDP. He's trying to forecast what the first half hit is going to be to US GDP, and as of right now, he's looking for a 12% GDP hit for the US, which is truly, truly unprecedented. And it tells us that we are obviously in a deep recession. So let's just be very clear that the economic data is supporting a very deep recession. Employment numbers, let's put that in perspective. We're anticipating about 30 million in new unemployed claims. And that has all happened in a span of 7 weeks. To put that in perspective, in February, when life was normal, we had 152 million employed Americans. So if you take 30 million out of the workforce, that is a 15 to 20% unemployment number in 7 weeks. Those are just 2 data points of many that show the severity of this. And our economists try to get our arms around what can we really look at to get a sense as to where we're going. And so we frame things up in threes as well. Maybe just framing things up in threes is easy. But we say the 3 things that we're really looking at is, number 1, what's going on with public health, and that seems to be changing every day, but that's the one that we have no control over. The second and the third are things that we can get our arms around, and it's really what are the stimulus packages that are being put together. Number 1, by the fiscal element, the federal government getting checks in people's hands, getting support into small businesses so that they can kind of keep the ship afloat. And the second is with the Fed and all the liquidity support and monetary support they're providing. If you're able to go to the next page, it's hard to get your arms around all these programs, but this is a little bit of a spectrum as to what the Fed is doing. And the Fed is providing, I'm trying to look at my notes here that, Mike, you mentioned that fiscal stimulus is getting to be about $3 trillion.
Right.
The Fed is providing the additional $4 trillion to get to the number that we've been quoting, which is a $7 trillion collective package. $7 trillion is a heck of a lot of money to put together and try to get into people's pockets in a few short weeks. So the Fed is really trying to provide liquidity across the spectrum. And what that means is they're going to be buyers of securities, buyers out there to provide a little bit of calm, because one of the things that we saw in March, which we all experienced, is tremendous volatility on a day-to-day basis. A lot of that had to do with lack of liquidity, and the Fed has come in and provided that. And since this was published, they actually went one further step up this spectrum and said that they would start buying high-yield bonds at the ETF level. Our firm believes that if they needed to, they would also buy equities. We think that they are going to put the kitchen sink and everything else to provide liquidity to the market. So this is a little bit of an idea as to some of the programs. If I was just to put a big thought bubble on top of everything, because there's so many things to talk about, every crisis has an existential question hanging over it. And this one, in our opinion, the existential question is this: are all of these programs going to be enough to bridge us to the other side of this? Because we know society is going to be slow to walk back into normalized activity. Is $7 trillion enough to create a bridge to the other side? And if it's not enough, will they continue to put more stimulus in play? Our firm believes that they are going to continue to provide this support to make sure that the economic ship doesn't take on too much water to go from a deep recession into a depression. So if you're going to look at anything, look at these programs and look at the severity and the depth of them. Now, once again, I know this is a 52 slide deck. I'm going to go through this fairly quickly, but let's go to slide 9. If you want a case study of a region in the world that is a little ahead of us in this whole scenario, it would be China. China obviously was the first to initiate where the virus had a cluster, and they also were the first to initiate a lockdown in society to try to, quote unquote, flatten the curve. Well, there's a lot of data here, but if you look at the left-hand side, you can see this dotted line where the China lockdown started at the beginning of February. The left side of that shows what the Chinese equity index was prior to the lockdown relative to the S&P. Well, the US market was doing just fine. The Chinese market was getting hit. But as the number of cases started to flatline, what you started to see was the Chinese equity markets recover, and you started to see the US markets falter. What's interesting is over on the right, if you look at China, that's positioned themselves as the factory floor of the globe, their PMI numbers snapped back almost like the snap of a finger. They shut down their factories, and then they immediately ramped them back up. So it's very interesting when we look at all these unemployment numbers to say that this external event has created a short-term pain, but as quickly as we turned it off, a lot of these measures are going to be turned back on. And China's an interesting case study in that. Obviously a little bit different. They're a little bit more of an industrialized economy. We're more of a service economy, but we think it's an interesting case study nonetheless. I'm clipping very quickly to a few more slides. Slide 12, please.
Hey, Jason, I'm just curious, how well can we actually trust that Chinese PMI number?
You can't really trust it, to be honest with you. You can't really trust it. The Chinese have always tried to kind of dial their economic number to kind of a 6% GDP number all the time. So you do have to take it with a little grain of salt. But I think directionally, Patrick, those sharp directions are something that you can maybe take a little bit of, you can take a little bit from that, maybe not the absolute numbers, but those directions I think are something you can glean some hope from. Now, we do get the question about the recovery, and we always say, what letter is the recovery going to be? Right now, the equity market is saying it's going to be a V recovery. We are not of the belief of that. I think, Mike, you quoted that intraday, the S&P's at negative 8%. We like to say that the world feels a little bit more than 8% off right now, and actually I'll show you at the end of this presentation that we think if you quantify the economic data to a multiple, we should probably be down about 22% in the equity markets. And right now we're down 8%. So we fully anticipate that we're going to see a little bit more fits and starts But a lot of it is driven on what's going on with the public health and how the economic engine starts creeping back into shape. If we could go to slide 18, that have happened in light of the market going from flowing to being turned off. And it really has to do in the fixed income markets have been really hit the most by this crisis environment. And anything that is a credit instrument has actually experienced tremendous volatility. So I know, Patrick, you're an expert in the financial markets, have a history in financial markets. For those of you that don't, let me just tell you what you're looking at on this slide, because I think it's pretty interesting. If you think of the bond market, I think of the world in two different paths. You've got high quality bonds that are the treasuries, and you've got anything else that's got a credit risk associated to it. And when you're looking at anything else that's not treasuries, you look at credit spreads. And if there's risk in the market, credit spreads go up because the market's saying you need to pay me more to take the risk. And when risk is not prevalent, spreads are very low.
So maybe just use in layman terms, you call it interest rates when you're talking about credit spreads.
Yeah.
Like an issuer has to pay more for their debt now than they did before.
Without a doubt. So I always think that the treasury is the base and the interest right, that you have to pay. And we call that the spread, the icing, the interest rate above kind of the risk-free rate to kind of find market equilibrium. So what you'll see, these are different fixed income sectors and what their credit range has been over the last 12 months. And you can see that everyone has went from very low to very high very quickly. And we're trading at some of the tops of these mountains right now. They've come in a little bit, but this to me tells me that the fixed income market is still looking for a lot of price discovery because they're not quite sure how to attribute risk to this current situation. They're concerned about default, it's not being made, and they're pricing it in. Interesting is the equity market is blowing past and moving a little bit of what the credit markets are doing. So that dislocation is interesting. Do you have a comment on that?
Well, yeah, I just was going to relate it to our audience of, privately held business owners, members of EO. Is it fair to say that this graph and widening credit spreads is an indication that business owners are going to have to pay their money in the future, meaning they're going to have to pay higher interest rates if they're getting traditional loans? Would this be an indicator that would be happening?
Yeah, that's a great way to kind of bring it down to what does this really mean? I'm looking at this from an investment lens, which is this is an opportunity to deploy capital here. But if you are trying to get new loans today in the market, this is going to actually extend what those interest rates are going to be for a lot of business loans. And we are fully anticipating that these spreads are going to come in, but at the moment, they're certainly elevated, and there's multiple implications to that. As a business owner, probably most importantly, it makes your cost of capital higher. As an investor, these are opportunities to kind of move into this market. But this just shows a little bit of a disconnect. I'm going to fast forward to 31, and then I would love to start opening it up to some questions here. 31 is a little bit of an eye test chart, so I apologize, but I'll try to bring this to life for you here. If we weren't emotional and we were just robots and we looked at the market as a function of two things, the equity markets. The equity market should be trading based on what their earnings are and based on what the price you're willing to pay for those forward earnings, okay? So this chart shows up at the top what the overall S&P earnings per share is when we moved into 2020. So we started at this kind of index level earnings per share of 157. You can see right below that, there's a 0% there. That's what we entered the year at as an index. Well, obviously the world has changed and people are saying that earnings are going to decline double digits. So let's assume that they're going to go down 16%. So let's bring our eyes over to the left. And you can see 16% means that earnings will be 132 at the index level. Now you can put a price multiple on that, and let's assume we put 19 times on that, which means the market's willing to pay 19 times for these future earnings. This gets you to that 22% negative number that I was referring to. And if the market's trading at -8% right now, this data would argue that there's probably a little bit of an overextension in this current rally, and we could see a step back to get to this. That's a kind way of saying expect a pullback in the near term. But this is a way to kind of figure out where we are, where we should be, and maybe the market's kind of pricing in a little bit ahead of itself. The last slide that I have is slide 36, which is my optimistic slide. And it's something I don't think a lot of people are talking about, but it's really, really important. And it's how much money is on the sidelines today. This is an aggregate number of money market assets, and there's $4 trillion in quote unquote cash on the sidelines. This is a very healthy number. Prior crises, we saw this in 2008, a similar number. But once that money starts going back into the market and starts getting invested, alongside $7 trillion in stimulus, this is kind of that dry powder catalyst that we think is building this bridge to the other side. So while there's a lot of unknowns, there's a lot of fundamental pieces that are providing a lot of support in the market and the economy that we think will certainly help us on the other side of the virus, so to speak. So let me pause right there. Once again, there's a lot of off ramps we could take, but I want to just stop my comments there, see if Bill and Mike want to add to that, and see if there's any questions from Patrick.
Yeah, I think one of the the big question I've been hearing from entrepreneurs, business owners, they've been talking about tapping into retirement accounts, and I know Bill, Mike, you probably don't want to stay away from a little bit of financial advice, but when a business owner is in crisis, let's bring this down to what it means for our members. We're kind of hearing that, geez, the markets are probably oversold and stuff like that. What do you say to a wide-eyed entrepreneur that's trying to figure out how to bridge this chaotic time? Should they liquidate and take a against their retirement account and get out of some stocks and get to some security here to get through these chaotic times? What does that conversation look like with a business owner?
This is Mike here. There's a lot of parts to that. Taking out of your retirement account obviously has long-term ramifications, but when the business needs crucial help, that's important too. And there's things to look at too, depending. You can take a loan out for certain levels that are usually approved if your company runs a plan. If it's an IRA, it's a little bit different. This is a group that's younger. There's a penalty on that of 10%, and then you have your tax bracket on top of it. So it can be very costly funds, and so you have to look at that too. But the nature of the overall risk, it's not two-dimensional, it's three-dimensional, and I think you have to look at a lot of those factors too. It's a lot of times it's a source of a lot of capital for individuals and can be very helpful. It's harder to pledge. I guess that's something we should talk to our friends at Fidelity about. But there's definitely some pitfalls. We look at it as a case-by-case event.
And is it true, are you guys familiar with, I had heard and I've done research, is it true that there's been some easing where somebody can get a loan against their retirement account for the next years or something, where they've made it without penalty or something? Are you seeing that?
I'm not aware of that. I don't know if Bill and Jason can. I haven't seen that. There's a 60-day rollover provision in an IRA that you can take money out and put it back within 60 days, and it's not a taxable event. Retirement plans allow for 50% of the balance to $50,000 typically, and then there's terms based on the loan policy of that. But I haven't seen that. I don't know, Bill, Jason.
Yeah, I think that it has been. It is more flexible. They've actually increased that 50,000 now to 100,000, and from a 401k. Using your IRA is challenging because typically you cannot pledge that as a loan. And so, and withdrawing it's just going to be very expensive. But to the extent you can access your 401k and borrow from the 401k up to 100,000, and then you're paying interest back to yourself, that can probably be a pretty smart move. I mean, the interest, the risk you're taking is all on you. You're paying yourself a 5% interest rate, I think something like that, on 100,000, and then you can use that for an extended period of time. You have to be paying it back. You have to regularly pay it back. And that may be, Patrick, where the rules have loosened up a little bit. But that'd be for up to 100,000. That would probably be a good source.
Okay. And do you guys want to share some insights? Like, how have you been thinking about it with clients in terms of transitioning these markets? I would imagine you guys were already in a little bit of a, play it cautious mode because the markets were already overheated leading into this pandemic. So going into the pandemic, and now it's really in our face, the economy shutting down. Have you gone even more cautious? Can you kind of comment on, what you're doing with your clients in terms of protecting assets, yet making sure that they don't miss up on the long-term upsides? Sure.
Mike, you want to go?
Yeah, right. So we run a number of different models. What we try to do is kind of keep the risk fulcrum in the same spot. So if you're, Patrick, as an example, if you have a balanced strategy, we're going to allocate amongst many diversified sectors to control risk that way. And as things become more and less attractive, we're always trying to keep that risk fulcrum with what's appropriate with somebody's profile. So the point you made, in November, we looked at the market valuations. You had an economy that was very long in expansion. Central banks have we're leaning towards doing more easing and keeping it going, but we're getting tired. So our model had moved stuff back a little in November, and then through January and February a little bit more. We definitely take risk off. To what Jason said, we echo. We think that this market is going to have these big rolling waves, and we believe that we're going to test those bottoms again. We're certainly going to roll over. It's hard to substantiate these values. The market can be emotional in the short term, but usually gets it right in longer waves. So this market coming back up, we're looking at it as an opportunity to reaffirm that the risk is appropriate, and in some cases, what's the probability with the S&P where it is doing, well through the end of the year vis-a-vis high yield bonds that'll guarantee a higher return. I mean, we think we can get some of that return by stepping the risk down too.
Yeah, and this money market asset slide, I'm happy this one is up, and maybe Jason, you can opine on this. But back in 2009, we had an issue with what they call breaking the dollar, breaking the buck, right? And so some of these what were considered safe money markets were actually dipping below $1, and the Fed had to step in and so on and so forth. But do we have any indications that some of our money market accounts or anything that we may consider super safe could have some type of risk that we haven't fully appreciated because of the $7 trillion and the shutdown in the economy and some of the other funky things that are happening with the credit spreads? You guys seeing anything that we should be aware of?
I'll chime in for a second, since this is a slide that I brought up. One of the things I would go back to is the Federal Reserve and their unlimited purchasing power to provide liquidity to the financial markets. They have basically said that if there is any pressure in the markets, they are going to be purchasers. And from our standpoint, that means the breaking of the buck is off the table, completely off the table. So from a risk standpoint, we're feeling very comfortable that money markets are going to be supported through that Federal Reserve liquidity program. That's our take.
Okay. Thank you. Because there's no shortage. Oh, go ahead, Mike.
I was going to say banks are in terrific shape. I mean, the stress tests and the financial condition of banks are so different than '07, '08. I mean, that was when we broke the buck. That was one of the scariest days I've ever had in this career. Nothing feels like that at all. And so we're not weak. I concur with everything Jason said there.
Yeah, I'm happy you brought that up, Mike, because I've been the same way as the scary point in time. I mean, 99.9% of people don't realize that literally at the precipice of people not being paid. Like payrolls weren't going to be. So it was just a very different time and place. What do you know, I'm seeing some people that are, starting to say, well, okay, we get this bridge, $7 trillion, which is just mind-bending. $1 trillion mind-bending, but $7 trillion just nearly infinite. And we hadn't even come back from the '08, '09 recession in terms of the quantity easing and taking that money off the table. So we're just continuing to pile it on. So, of course, there's always the gold bugs, right? And now oil's in a unique situation and so forth. Any thoughts about gold as an investment, or oil? I mean, typically these commodities have historically not been a great investment vehicle, but we are in unprecedented times. I think there's some valid arguments being made for these types of assets. What are your thoughts?
Well, this is Bill. I'll just take a little bit. I mean, I think the gold has certainly done well in this environment. It's been rising, and it's the classic safe haven commodity, and it's kind of doing its job here in this environment. Typically gold is not a great investment because there's really no earnings to it, and it's just a commodity that goes up in value and does not even have a tremendous amount of commercial use. But in this situation as a safe haven, it's been working. Oil, as we all know, has just been wild. We have some clients who have speculated on the crash of oil, but that's I think a very dangerous game to play. I mean, you got to have a lot of guts and a lot of discipline to play it, and know you could if you're going to do that, I'd be very careful and wouldn't allocate a lot to that. I mean, at some point, I shouldn't say obviously, but it would appear that oil will eventually come back, but this could be a long wait. And it's also trading in the oil world that's a professional's game. So it's very hard to do that as an individual investor successfully. As long as I've got you just here for 1 second, I just double checked the rules. The borrow from the 401k is $100,000 now. But you can also take $100,000 out of your IRA, up to $100,000 out of your IRA before age 59.5 without penalty. So you avoid the 10% penalty, but you will still be subject to tax. So I'd be very careful about paying tax to get access to money, because that's an expensive use of cash.
Excellent. Yeah, those are really good insights. And thank you to Brad. I see he's been posting on the chat function here to help with some of those resources as well. Well, as we kind of draw this to a close, we are allotted an hour here to spend with everybody. This is a time when, financial advisors are worth their weight in gold. Really be that lighthouse in the storm to people through navigating uncertainty, to keep them focused on the long. Any thoughts that you want to share about how people be thinking about navigating basis and where minds should be, and making that they don't make financial mistakes them in 10 years? What thoughts, somebody's coming to you panicky, what are those words of wisdom that you want to share with our entrepreneurial members?
Sure. This is Mike. I just close it out with the thoughts that, what we often see in 30 years of doing this is that a good cogent strategy and philosophy adhered to wins overall. So understand your risk, understand what you're trying to accomplish, and stick to the plan. The market will try several times to chase you out of that confidence, but it works over time. So we would literally, it's how often do you hear it's how you buy something that determines how you make the money on it. and not necessarily, how you sell it. Well, I guess it's both, but be really careful and exacting on finding out what the right profile is, and then stick to it. And that's it. We use active management and passive management. We're agnostic over the pieces. What we try to do is really take advantage of how the portfolio can be the least risky and be commensurate with your profile. So we would just say, don't panic. This will pass. I think we all believe, and most of the firms we talk to, that this is going to end at some point sooner than not. So.
I saved the toughest question for last. Brad wants to know, Mike, when the Lions are going to win the Super Bowl.
This is our year. This is our year. There's no question. I think that's a good investment to bank on the Lions to win this year.
Can you buy stock in the Lions somehow? Can you get a piece of that upside?
I got my Lions right here.
There you go.
They're going to win it the year they don't play. That's right.
Yes. Well, I'm just going to wrap this up by saying, my whole background and career has been in finance, and Dane Rauscher in Minneapolis, and now, of course, now RBC, Dane Rauscher, Royal Bank of Canada, being one of the largest banks in the world, coming together. It's one of the absolute best firms out there. We are very lucky as Entrepreneurs Organization to have RBC Wealth Management as sponsors. The team at Lambert Dixon doesn't get any better than this. So for all of our members, we're very well suited to get the insights from our strategic alliance partner. And if you don't have somebody that's helping you look over your accounts and understand what your financial future looks like, please make sure to reach out to Mike and Bill and the team, because you would be very, very well served. So with that, thank you everybody for being on here today. Again, reminder, we have an EO Global event later on this afternoon and an EO Minnesota event tomorrow. So check that out and make sure you get those things on. And also a big thank you. It looks like you might have dropped, but a big thank you for Jason being here with AllianceBernstein as well to help his friends out at RBC share some insights. So with that, well done. Thank you, guys. That was tremendous. Thank you, Mike. Thank you, Bill.
Great. Thanks, Patrick.
Yep. Best luck with everything, and we'll talk again soon.